Funsupermart.com.
What is your expectation of global economies for 2014?
First, 2014 will be different than 2013, which is important to mention. And the reason is twofold. First, because growth is back everywhere. Of course, it's bigger in the United States than in Europe, but growth is back, including in Europe and including Eurozone. The second major change is dealing with the monetary policy. As you know, the Fed will start reducing its purchases of assets, which means that the global picture for the bond market will be different in 2014. So first on growth will be stronger in the United States, growth will be stronger in Europe, and globally, growth will double in the advanced countries, while it will stay at the same level in the emerging countries. Positive growth, strong growth, but the dynamics is much bigger as we speak in the advanced countries. Second, on monetary policy, we have to mention that when we talk about monetary policy, we have three tools. The first one is interest rate, the second one is quantitative easing, and the third one is forward guidance. What we know is that interest rates will not change in Europe, in Japan for a while, probably 2018 in Japan, 2016 in Europe, and the Fed will not tighten monetary policy in 2015, but of course, they will alleviate the QE, which means that we'll have higher volatility and higher rates, higher yields in US, and it will have an impact on the other economies.
What is your expectation for global emerging markets in 2014?
In 2013, we had a wake-up call with the emerging market. A lot of people realize that the emerging economies is not a block. In fact, it is a block when things are going bad. In fact, if you look at between May and September, all the emerging markets went down because we had a high sensitivity to bond yields in the United States, and because when the people decide to disinvest in emerging market, they tend to sell everything. The good news is that growth is gaining momentum, and the good news is that all the countries are now supposed to be in a better shape, and the 2014 might be a year where we have to be selective, but a lot of countries have very strong fundamentals, very low financial vulnerability, and we had a major change as well in the currency side, which means that we can have some countries being attractive, but of course, to be highly selective is probably the best play we can have in emerging economies.
What about your expectation for Europe in 2014?
Europe is getting better. Not well, but better. In fact, what is remarkable is that if you look at the investment we had in the markets everywhere, in 2013, a lot of people were long emerging, long sovereign debt, and short Europe. And in fact, those three strategies were very painful. The good news for 2014 is that one by one, the countries are exiting recession. It's not fantastic growth, but to have a positive growth while other countries one by one exiting recession is not that bad. It means that for the equity market, again, it can be very interesting because, as you know, there's a huge lag between US and Europe, for example, and in terms of valuation and in terms of profits for the companies, Europe is late, which means that if 2014 we have the sentiment, the confirmation that the growth is gaining momentum, 2014 might be the year where we close the gap between US and Europe.
Are there any risks for 2014 and why?
We have plenty of risk as usual. Probably one of the most important risks is some disappointment with some emerging economies. Again, we had a wake-up call in 2013, and the selectivity means that some countries will have difficulties to finance their financing needs. So to pay attention to the countries with current account surplus and low external financing needs means something for 2014. The other risk is about China. We are not negative on China, but we pay attention to plenty of things. For example, the banking system, the internal debt, and the capacity of China to restore potential growth, having higher productivity. That means to change the business model. We are not negative in the sense that China will succeed, but of course the market will be mostly volatile. The other risk we might have is about Japan. The Japanese yen is very low, very weak, and is expected to weaken further. And one of the risks we have in Asia is to have a real currency war, between the countries.
How should investors position their portfolios in 2014?
In the current environment, that's clear that equities are much better than the fixed income. Bond yields will rise in the US. In contagion, we will have the same kind of rise, to a lesser extent anyway, in the other countries, including Europe, Japan, and some emerging. So as a consequence, with growth gaining momentum, with higher bond yields, equities are better. If you look at the fixed income area, corporate bonds are much better than the sovereign debt. If we go back to the emerging market, we have to pay attention to the difference between the countries. As I said, we have the wake-up call last year, and some countries are vulnerable, some are not. And we tend to prefer these kind of countries. To make a long story short, Asia is better than Latin America is better than Central Europe. And within Asia, our favorites are the countries where we have a weak vulnerability. Malaysia, Philippines, for example, are two contenders for us, and we like this country that much. For the credit market, what is interesting is that we have to take into account the increase in bond yields. And as a consequence, if you look at the credit, some segment in the market would be hurt because of the rise in rates, but will make profit because of carry. So high yield is much better than investment grade for 2014.